Hi, I'm Chris Holcomb, Corporate Sales Manager for Vida Home Loans. I'm going to be speaking to you today about how specialist lending is becoming the new mainstream, especially when it comes to buy-to-let, and examining what's in store for that sector of the market as we move into the second half of the year. I'm going to try to cover off a lot of ground, starting with the underlying structure of the buy-to-let market, including the many changes that your clients have had to cope with in the past few years. I think it's fair to say that those reforms, as the government will call them, are not over yet by any means. But having said that, the buy-to-let market has a degree of resilience that makes its long-term future secure, and the next 18 months a rewarding time to be in the buy-to-let market. Now, the COVID-19 pandemic has naturally affected landlords just like everyone else. So I'm going to look at what you need to know about the shift in financial complexity that many of your landlord clients now face and how you can support them moving forward. The strict lending criteria of high street lenders, combined with continuing house price inflation, which is around 10% in the year to March according to the ONS, and the limited availability of social housing, makes it almost impossible for many would-be buyers to get onto the property ladder. As a result, more and more people are seeking out private rental accommodation instead. The underlying driver of the UK's buy-to-let market, which is tenant demand, remains strong. And although the COVID-19 pandemic has certainly had an impact on the rental market as people have moved out of cities in search for more space, recent data from Zoopla is showing us that there are growing signs renters are beginning to return to the city life, with tenant demand up by 26% in central Edinburgh, 12% in centre of Leeds and 7% in central London. Now, statistics from RICS has also shown us that there was a 26% increase in overall tenant demand in the 3 months to February 2021. But it's not just in the cities that demand for rented accommodation is buoyant. A change in working practices means that people are no longer feeling the need to live within a close commuting distance of the office and are instead looking to rent in smaller towns and more rural settings. But of course, it's important to note that although the pandemic may have made them more pronounced, the long-term flows of people moving in and out of cities or rented accommodation are often based on individual circumstances. Now, this is meaning that the fluctuations we've seen over the last year have been seen before in the buy-to-let market. The key for intermediaries is to track the trends and be ready to help your landlords find the right property in the right place at the right price. Now, if we look back over the last 12 months, from a deadly pandemic to a global movement for racial justice, the year 2020 certainly experienced its fair share of world-shifting events. And it seems a long time ago when the World Health Organization announced on the 9th of January 2020 that a deadly virus had emerged in Wuhan, China. In a matter of months, the virus had spread across the globe and dominated all of our thoughts. With over 137 million cases having been recorded, resulting in over 2.9 million deaths, a figure that continues to grow. Now, the national lockdowns and socially distant measures that have become usual event for us all, and the need for businesses to stay closed or working at much lower capacity, has affected many industries, leading to the 3 largest falls in GDP since records began in 1997. Let's take a look at the travel industry, for example. The UK has a rich history as a global transport hub, and while we value our holidays as individuals, the value of travel to the UK economy cannot be overlooked. In 2019, the 40.9 million overseas visitors who came to the UK spent over £28 billion. And while many of us won't consider the UK economy to be as dependent on tourism as some of our European counterparts, in 2018, the UK actually ranked 8th in the International Tourist Arrivals League, with London ranking as the second most visited city in the world behind Hong Kong. If we look at the self-employed, this is a population badly hit by the pandemic, with 29% having fallen behind on at least one household bill or credit card commitment, according to the Money Charity, and 4 million of the self-employed or small business owners not being classed as eligible for support from the Self-Employed Income Support Scheme. If we look at the period February to October 2020, the number of 18 to 24-year-olds in registered employment fell by 222,000, which was potentially due to the number of companies cutting their cloth in order to stay afloat. In terms of redundancies, 454,000 people have reported they've been made redundant in the year to December 2020. And then if we just look at the FTSE 100, it fell during 2020 14.3%, the poorest performance among the largest international stock indices, and its biggest decline since the market crash of 2008, all of which are quite striking. If we just look at household debt, it's estimated to be an average of £60,000 as of February 2021, which is the equivalent to 108.2% of earnings. Now, the charity Turn to Us have estimated that 1 in 4 people are not expected to recover financially from the pandemic for at least a 12-month period. And then if we look at payment holidays or payment deferrals, as they can otherwise be known, at their peak, there were over 1.8 million borrowers having taken advantage of the deferral, which was 17% of all borrowers. And still, by late November, there were 127,000 borrowers on payment deferrals alone. Now, you may have seen that Vida recently carried out some research where we surveyed 2,000 adults across the UK to better understand the challenges faced by today's would-be borrowers. The report examines who's stuck in the private rental sector and why, and it understood in greater detail those individuals who previously have bought but now can't due to changing credit conditions caused by COVID-19. The report shows such a strong specialist lending sector as being vital and more important than ever for millions of the self-employed and first-time buyers, including key workers who have played such a vital role during the crisis. Now, COVID-19 has been a blow to the plans to tens and thousands of prospective homeowners in 2020. 1 in 5 who are planning to purchase a property during the year said they were cancelling, mostly directly or indirectly due to the impact of the virus. Strikingly, 40% said that COVID had made it harder to save for a deposit to get on the property ladder, whilst a third said they intended to wait to see if house prices would fall in order to make them more affordable. 29% said a drop in income due to the crisis had upset their plans, whilst 22% were avoiding viewing properties due to social distancing. Now, solving the challenge posed by generational rent is not impossible, but it requires us all to roll up our sleeves and work together, government, the housing sector and the mortgage market, to provide solutions for consumers who have been underserved and overlooked for too long. We need to innovate new mortgage options that provide a real solution for those stuck in generation rent. And we need to ensure that those feeling the economic effects of this unprecedented crisis still have the opportunity to find a home of their own in the future. The pandemic and lockdowns have also not surprisingly influenced what potential buyers look for in a property. Gardens, local parks, and extra indoor space are all increasingly important to buyers. In fact, in the study that we undertook, 57% said the crisis had made outdoor space more important, whilst 45% said they valued indoor space more. 53% said the same for the proximity to green spaces like parks. But we also see the influence of the past year on the drivers for home ownership. On the one hand, traditional financial considerations remain key drivers. Indeed, the economic uncertainty the pandemic has brought is likely to have boosted these. But on the other hand, the ability to modify the property, creating more space or new room for a home office, for example, is really likely to have taken on new significance. Now, for the under 35s, it's now the main benefit they see over renting after the security home ownership provides. The decline in home ownership and decrease in first-time buyers predates the pandemic by years. The financial crisis of 2007 and 2008 saw first-time buyer numbers, already well down from 500,000 at the start of the century, drop by almost half. Now, those numbers have never fully recovered. COVID-19, though, has been a blow to the plans of tens of thousands of prospective homeowners in 2020. And as I said, 1 in 5 who are planning to purchase a property during the year have said they're cancelling. Now, as well as the challenges since March 2020, landlords have had to navigate the difficult buy-to-let market landscape in recent years as the government has imposed a raft of regulations on the sector. Reforms have included the introduction in 2016 of a 3% surcharge to stamp duty land tax for landlords and the phasing out of mortgage tax relief on buy-to-let properties. Tougher lending rules regarding stress tests and interest cover ratios have also created a particularly challenging environment for buy-to-let mortgage borrowers. In addition, landlords with properties classed as HMOs or house in multiple occupation are now subject to mandatory licensing if they have 5 or more tenants living in the property. For many landlords, HMOs can be attractive as they can mean higher rental yields than vanilla buy-to-let properties. And demand for shared living accommodation tends to remain robust against the background of economic change and uncertainty as tenants seek affordable rooms to rent. In fact, the demand for affordable, flexible housing as offered by multi-let properties has never actually been higher. However, the changes in licensing effective from October 2018 have created an extra burden on landlords to ensure they comply with their local council regulations, and data suggests an additional 177,000 HMOs became subject to the mandatory licensing in England alone as a result of this change. Now, the Tenant Fees Act of June 2019 introduced a further restraint, banning most letting fees and capping tenancy deposits paid by tenants in the private rented sector in England. Now, a government review of Section 21 of the Housing Act 1988, which intends to abolish ground rents for no-fault evictions, could have a big impact on the rental market. Indeed, a report from Lettings Industry Council suggests that such a move could lead to a 20% collapse in the number of properties available to let, combined with soaring rents. Now, in line with the government's target to make UK housing carbon neutral by 2050, landlords will also be required to ensure that their property being let for new tenancies has an energy performance rating of at least C by April 2025. And this will be extended further, with all let properties needing to meet this requirement by 2028. Now, whilst around 38% of privately rented accommodation has an EPC rating of C or above, there are going to be many landlords who face mounting costs to make sure their properties meet these standards, particularly those with mid-terraced or older properties. Finally, capital gains tax could be on the next government initiative. The Office of Tax Simplification has suggested an alignment of CGT and income tax and lowering of the threshold at which it's paid. What this would mean is that CGT on the sale of a buy-to-let property or second home could increase from 10% to 20% for basic rate taxpayers, from 28% to 40% for higher rate taxpayers, with additional rate taxpayers paying 45%. Now, a recent Hampton study has estimated that around 250,000 fewer buy-to-let properties have been bought since 2016 as a result of the measures we've discussed related to the stamp duty. Despite this challenging environment, for landlords, the buy-to-let market has remained resilient. And although there was a slowdown in the buy-to-let market in 2020, a modest recovery is expected in the overall buy-to-let lending in 2021 to £40 billion, with buy-to-let remortgaging expected to increase to £28.2 billion this year. In fact, although it's estimated that overall buy-to-let lending in 2020 was down around 10% to an estimated £38 billion, the underlying growth in outstanding buy-to-let mortgage debt remained broadly consistent during the period 2020, and the number of buy-to-let mortgages actually increased by around 2%, showing us that the buy-to-let market remains robust in underlying terms. Now, with a positive outlook for the months to come, the spotlight is on the buy-to-let market and opportunities for landlords and brokers. The Chancellor's announcement about the stamp duty holiday being extended to June 2021 and then the tapering to September has provided further boost to lending as landlords look to take advantage of this tax break, even though that they still face the 3% surcharge introduced back in April 2016. Data from UK Finance shows that the mortgage loans written for buy-to-let house purchases during Q4 2020 were the highest since Q1 2016, when the stamp duty surcharge for landlords was introduced itself. And with the extension of the tax break, more landlords are looking to expand their portfolio than reduce for the first time in 4 years. Now, there are several other trends we can expect to see in the buy-to-let market over the next few months, which brokers should be aware of. For example, data from Hamptons shows us that the proportion of buy-to-let purchases financed with cash hit the lowest level in 8 years in 2020. Now, this is largely driven by a greater number of smaller and amateur landlords returning to the market and using mortgage borrowing to purchase the properties. Indeed, MoneyFacts data from February shows that the number of first-time landlords has increased by 4% in the last year, and that 65% of buy-to-let mortgage deals are within this demographic. Now, this trend is only set to continue to rise over the rest of the year and represents another opportunity for brokers to show the value that their advice gives to inexperienced landlords who seek the right mortgage solution for them. Now, while the tapered stamp duty holiday will undoubtedly create more opportunities for mortgage intermediaries over the coming months, buy-to-let remortgaging is also set to increase as landlords who took out a 5-year fixed term in 2016 in response to tougher lending rules come to an end of their term. Now, for brokers, it's the time to approach these landlords who will be seeking more affordable mortgage products or who are looking to raise capital to fund a new purchase. Alongside an expected increase in remortgaging, the sector is also likely to see an increase in product transfers. Now, this is good news for lenders who have invested in online systems that allow borrowers to take a product transfer, which proved especially effective during lockdown. The relatively strong performance of product transfers in 2020 may well be because they're particularly easy to execute with social distancing requirements, and given that most lenders offer product transfers on an unadvised basis through online portals, whilst broker-assisted remortgages involve advice. While intermediaries managed to increase their share of lending during 2020 at the expense of lender distribution, lenders were able to forge ahead with product transfers. Now, as this chart shows, since data has been available on product transfers where the borrower moves between products with the same lender, it's been clear that the majority of borrowers who refinance are doing so with their product transfer. But until the lockdown, there were no discernible trends in the proportion taken of product transfer, which remained in the low 70% of those refinancing. However, in Q2 and Q3 2020, product transfers increased their share of refinances to 77% and 79% respectively, whilst remortgages dropped. So while the buy-to-let outlook may appear positive as we begin to emerge from the pandemic, the impact of COVID-19 on people's finances will have a lasting effect on this industry. Landlords are not immune from these concerns, especially those who have faced gaps in their rental yield or have picked up minor credit blips during this period. Now, even before the pandemic, there was a clear shift away from vanilla borrowers to customers with more complex financial situations, including landlords who didn't meet the rigid criteria of high street banks. As a result, specialist lenders have become vital in making sure these landlords have access to the support they need. Now, according to the UK Finance, specialist buy-to-let makes up 20% of the overall market, and this is only set to increase given the long-term implications of the pandemic. Now, with a new generation of borrowers with impaired access to credit, many landlords will need the support of a strong specialist lender that takes a flexible and human approach to lending, especially when dealing with complex circumstances. But it's not just those who have been financially impacted by the pandemic who will need support from the specialist lending sector. For landlords investing in HMOs or multi-unit blocks, there are several specialist lenders who have entered this market or broadened their criteria in recent years, meaning these landlords have greater choice, more flexibility and affordable options at their disposal. Now, equally, landlords who use SPVs to take advantage of the tax efficiencies are likely to need the support of specialist lending market. Now, a report by Hamptons claims that around half of buy-to-let properties are held in limited companies. And with the changes to mortgage interest relief and possible reform of capital gains tax being hinted at by the government, it's likely we'll see more landlords considering setting up limited companies to make sure their investments remain profitable. Now, the specialist lending sector has a real opportunity to meet these borrowers' needs, which is good news for landlords, lenders, and the economy. After all, a thriving rental sector is key to the recovery of the UK housing market. And with strong growth trajectory expected in the remortgage buy-to-let sector this year, lenders and brokers should do their part in driving the market forward. Now, Given the market changes we've seen in recent years, advice is more valuable than ever before. Intermediaries can add value in a way that going direct to a lender cannot, by providing advice that's tailored to the client's short, medium, and long-term plans based on whole of market advice. As such, advisors should prepare themselves with the right tools and technology to support conversations with the widest possible range of customers, including those complex credit histories. The market is changing, and so the industry needs to change with it. So I hope you found that useful, and I really appreciate your time listening to me today. And finally, I just want to say thank you to Brightstar for giving me the opportunity to be here. Thank you very much.